what is LIBOR? So before we get into the transition and what is happening around it and how our firms preparing for it, let's first see what LIBOR is. So LIBOR, or as the full form goes, the London Interbank Offered Rate. This is the benchmark rate at which banks estimate they can lend money to other banks on an unsecured basis. So there are a couple of important words to consider in these two sentences. It is a rate at which banks are lending to other banks. So in a way, it is it is in a way an estimation, and it is estimated as to bank A. So what is the rate at which bank A would be willing to lend to bank B? So this bank A and bank B might be in completely different countries. Because this is a lending that happens on between banks, it is mostly on an unsecured basis, but it is assumed that since these are banks interacting with each other, there is a lot of security involved in this number. If you look at LIBOR, and if you look at the benchmark rate, it is estimated that there is almost $200 trillion, which is almost 10 times the GDP of the US, that is you denominated in LIBOR or tied around to LIBOR in some way or the other. So this would mean almost 95% of this $200 trillion actually relates to derivative contracts. And the rest 5% is divided between business loans, floating rate notes and bonds, securitizations, and even consumer loans. So by the sheer volume of it, LIBOR is linked to several financial instruments. So of course, this transition is going to not cause not just ripples, but waves in the financial services industry. So before we get into why this transition happened or why was it needed, it is important to consider how LIBOR is calculated, because this gives us the trigger of the change. So there are 11 to 18 panel banks. So these are banks impaneled by the ICE who are responsible for submitting their estimates. So these 11 to 18 banks individually will estimate the rate at which they would borrow from other banks. So as we recall in the initial two sentences, we are talking about banks estimating the lending rate to each other. So these banks will give their estimates for a particular currency and for a particular given time period. And they would submit these estimations on a daily basis to ICE, which is the Intercontinental Exchange. So for a bank, you would consider there are multiple rates because there would be multiple currencies and multiple terms for which they would be submitting their estimations to the ICE. Now, the calculation, which is again happening on a daily basis, so ICE is discarding the highest and lowest of these submitted rates. So of all the rates that are coming in by these 11 to 18 banks, ICE would disregard the highest and the lowest and would calculate the mean of the remaining rates. Again, this calculation is being done by ICE for each tenure separately. So by tenure, I mean it can be an overnight rate or a 1 week rate or a 1 month rate, and each currency separately as well. So these are these multiple averaging that is being done by ICE on a daily basis. So if you look at what is published, so for each of the 5 different currencies, which is the US dollar, the euro, the pound, the Japanese yen, and the Swiss franc. So these 5 currencies are being used for LIBOR, and there are 7 different tenors that are being submitted. So there are overnight, 1 week, 1 month, 2 month, 3 months, 6 month, and 1 year LIBORs, which are published for all of these 5 currencies. So there are 35 LIBORs published every day. So the sheer volume and the sheer work around it is pretty much evident because these numbers are huge, and they are, as you said, it's almost $200 trillion worth of investment that is being tagged to these numbers. So this LIBOR, which is published every day, is then used for each of these derivatives or financial instruments, even corporate bonds, even business loans.